Hi everybody, this is lecture for topic 5. Okay, this topic is about financial statement analysis. In topic 1, 2, 3 and 4, you have learned about how to do accounting record. In order to do the accounting record, you have to follow accounting cycle. You have learned every step in the accounting cycle from step 1 to step 8 in the previous topic. So now you know the output of financial accounting is the financial statement. There are 5 components of the financial statement, but in this course you have to know how to prepare only 2 report. First, you have to know how to prepare the income statement, and the second is you have to know how to prepare the balance sheet. Okay, so you have learned that you have learned how to prepare the income statement and balance sheet. So remember this. Okay, now the thing that you have learned is these two report. See in the left side of this slide, you can see the income statement. So income statement, just to refresh your memory, income statement shows whether a business is making profit or loss. See here in this sample income statement, the business has a fixed revenue. So and then you have to minus all the expenses. So the total revenue is 7,500. Expenses is 4,550. So this business is making $3,050 profit. So the income statement shows the financial performance of the business. And then the second document that you have learned is the balance sheet. See the balance sheet in the, this is T format balance sheet. In the left side of the document or report, you can see the list of all assets, cash, supplies, land, etc. The total is 26,450, and then liabilities and owner's equity, the total is also 26,450. So the balance sheet, remember, shows the financial condition of a business. Okay, now these two are the output of financial accounting. Now in this chapter, you learn about how to analyze this income statement and balance sheet. If you do not analyze if you see the income statement and balance sheet, so now if you see this two document or report, you can see that this business is making $3,050 profit. So in general, you can say that the business is performing well because the business is making profit. In general, the general conclusion that you can make. And also you can see here, the asset of the business is 5,009. The total asset is 26,450. So and then the total liability is $400 only. So we can see that the total asset is higher compared to the total liability. And then we can say that in general, the business is in a good financial condition. So that is the general conclusion only. When we see the income statement and balance sheet, we can only make a general conclusion. But if you want to make a good conclusion about the business, financial performance and condition, you have to do financial statement analysis. Sometimes when you see the income statement, the business is making profit, but after you analyze, you know that the business is actually not performing well. maybe the business is making profit, but it is worse compared to the last year. Or the business is making profit, but it is less compared to other businesses in the same sector or industry. So that's why you have to analyze the financial statement first, and after that you can make a good conclusion. If you see the financial statement only without analyzing, then the best thing that you can do is you only can make a general conclusion only. So that's why you have to learn. That's why you have to learn about financial statement analysis, because you have to aware that if you want to make a good conclusion from the financial statement that you see, you have to analyze first. Okay, in this topic, you will learn three methods that can be used to analyze a financial statement. You will see that in the next slide. Okay, why people analyze financial statement, or what is the purpose of financial statement analysis? Okay, see here. The first point is to examine the relationship and trends among financial statement numbers. So you do financial statement analysis because you want to see the trends and relationships among the numbers that you can see in the financial statement. And the second thing is use past performance to predict future performance. You do financial statement analysis to predict the future of a business. And number 3, to evaluate performance with goal of identifying problem areas. So you do financial statement analysis also because you do it because if you want to know what is the problem with a business. So in conclusion, the conclusion is in the final point in the slide. Financial statement analysis is both diagnostic and prognostic. So if there is a question asked you, why people analyze financial statement? The answer is, it is done because of diagnostic and prognostic. Diagnostic means we do financial statement analysis to know what is the problem with a business. Let's say you see there is a business and this business is not doing well. The owner of the business say the business is not good. Is having a problem to continue operation. So how to know what is the real problem? So the one thing that you can do is to do the financial statement analysis. You do the analysis and then you will see what is the problem with the actual problem with the business. And then the second reason why people analyze financial statement is for the purpose of prognostic. Prognostic means you want to predict the future of a business. So in the future, sometimes or some people, they want to invest. So if they want to invest, they want to invest in a good business, a profitable business. Because if you invest in a business, your expectation is you want to get benefit from the investment in the future. You invest in a business, you want to get profit or dividend in the future. So how to know whether the business is good or not? So to know whether the business is good or not in the future, you can do financial statement analysis. You can do some analysis and then you can say, you can make a conclusion. Oh, this business will perform well in the future. Or this business is not going to perform well in the future. There is a way to do the analysis and make that kind of conclusion. Okay, so if somebody asks you or there is a question in the anywhere, ask you why you have to analyze financial statement, the answer is financial statement analysis is done for diagnostic and prognostic. Okay, who are the people that analyze financial statement? There are many people analyze a business financial statement. They do the analysis with their own purpose. They have their own purpose of doing the analysis. Okay, see here. External users and internal users they do financial statement analysis. External users decide whether to invest or lend money to a business. Remember these terms? The user of financial statement can be categorized into two groups: external users and internal users. The external users are people outside the business. So the biggest group of external users is the investors. Investor, like you know this. Investor, they have cash, they have money. They want to invest because they want to get return in the future. They want to get profit or return from in the future. So investor is one of the parties that do financial analysis before they invest in any company or in any business. They will analyze financial statement first. Why they do the financial analysis? To make investment decision. They want to do the analysis and then decide whether to invest or not to invest in a business or in a company. That is one group of external user. Another group of external user is the lender. Lenders are banks and financial institutions. They give loan. So they also do financial analysis. Before they give loan to any businesses, they analyze the financial statement of the business first. Why they do the financial analysis? Lenders do the financial analysis because they want to make lending decision, to give loan or not to give loan. Okay, remember, there are many users of financial statement. There are many users of financial statement. Most users do financial statement analysis, and each group of users have their own purpose. Investor do financial analysis because they want to make investment decision. Lenders do the financial analysis because they want to make lending decision, to give loan or to not give loan. Creditors also do financial statement analysis because they want to make credit decision. What else? Government do financial statement analysis. Specifically the tax authority. Every year they do the financial analysis and then they decide about the tax rate. How much they want to tax the business profit. Okay, that are the external users. You can see in the textbook that maybe there are more. Another one that is also important. Labor union. Labor union is an external user. Every year they analyze whether the financial statement of the company or of the business. Most of the time they want to check. They want to check, and if the business is performing well, they will request for bonus, salary increment, etc. Okay, that is about the external users. And another group of users of financial statement information is as the internal users. Internal users are people inside the business. The most important, the biggest, or the most frequently mentioned internal user is manager. Manager analyze financial statement because they want to make management decision. They want to make decision like to set the price for the product, to decide about how many quantities of how many quantity of the product has to be produced. They will decide about whether to open a new branch or not, whether to diverse to to continue operation or to close a segment. There are many decisions. Before they make the decision, they have to analyze the financial statement. Manager decide analyze financial statement because they want to make management decision. The second group of internal user is the workers or employees. Employees, they do financial statement analysis. Why? Because they want to make employment decision. If you in the future, if you are working in a business, you are an employee. So every year you have to do financial statement analysis. Every year you have to read or see the financial statement of the company that you are working in. If you see the company is performing well, then what is the employment decision that you will make? You will continue to work in the company because the company is performing well. And if you check that the company is getting worse, and the company performance is bad, and the future of the company is not good, then what will be the employment decision that you have to make? You have to find a job in other places. You cannot stay. That is what we call employment decision. You decide whether to continue to work or to stop and work in other places. That is the decision. That is the purpose of employee when they do financial statement analysis. Just remember, many people do the financial statement analysis, and each people or each party has their own purpose. Okay, so I have told you earlier, in this topic, you will learn about 3 ways or 3 methods that can be used to do financial statement analysis. Okay, method 1 is called horizontal analysis. Horizontal, just imagine what is the horizontal line. Horizontal line is like a flat line. Okay, so what is a horizontal analysis? The percentage analysis of increases and decreases in related item in comparative financial statements is called horizontal analysis. Okay, comparative financial statement means a financial statement that contain current year data and previous year data. That is what we call comparative financial statement. Okay, this is the way to do horizontal analysis for a balance sheet. See how to do it. So to do the horizontal analysis, you have to have 2 years data. See here, current year data and previous year data. For example, here we have Lincoln Company comparative balance sheet December 31st 2000x1 and 2000x2. So to do this analysis, horizontal analysis, you have to have 2 years data, year 2000x2 and year 2000x1. So this is the balance sheet. You see the list of all assets, and then a list of all liabilities, and a list of accounts related to equity. Okay, so here this is an example of a company's balance sheet. So that's why you can see the common stock. But for a sole proprietorship business, the account is account capital. For a company, we call it stock or shares. And then retained earnings. Retained earnings is the profit. Total stockholders' equity is the equity of the business. Equity, owner's equity. And then total liabilities and equity. Okay, so how to do it? To do this analysis, there are 2 steps. The first step is you have, remember to do this, you have to have 2 years data. And then the thing that you have to do for this analysis is you have to prepare a table that you can see in the column number 4 and 5 here. So So if a question asks you do a horizontal analysis, then you have to prepare the last two columns to answer the question. So what is the thing that you have to prepare? First, you have to show or calculate the increase or decrease in amount, and then you have to show the increase or decrease in percentage. So for example here, you see the first item in the column number 4 is current asset has increased 17,000. How to calculate the increment? $550,000 minus $533,000. So the increment is 17,000. And then the percentage of increment is 3.2%. How to calculate that? 17,000 divided by the previous year data, 533,000. So you will get 3.2%. So you have to calculate the increment and decrement in terms of amount and percentage for every item in the balance sheet. Okay, see here. All the items for the current asset, there is an increment. For the long-term investment, there is a decrement. Current liabilities, there is a decrement. Long-term liabilities also a decrement. And then you can see the accounts for the common stock. There is no difference. Okay, so this is the way to calculate it. Okay, see here. So the difference is 17,000, and then divided. How to calculate the percentage? You have to divide the amount of difference with the previous year data. So in this example, the previous year data is 533,000. So the difference is 3.2% increment. So let's see the second item. The difference is 82,000 negative. Divided the previous year data 177,500. So the decrement in terms of percentage is 46.5% decrement. Okay. Okay, now I have told you, if a question asks you to do a horizontal analysis, then first you have to prepare the column number 4 and 5. That is the first thing. The second thing is you have to know how to interpret the data. Okay, so let's see here. To interpret the data, remember the balance sheet is a statement or a document or a report that shows the financial condition of the business. So you can see here, the total asset is getting better or getting worse. So you have to know that the total asset is getting worse. A decrement in asset 7.4%. And then 7.4%. So if you see the number, so firstly, if you only see the total asset, you will say that the total the company is getting worse because asset has decreased by 7.4%. But when you check the total liabilities, you see that the total liabilities has decreased 30.0% in total. So now, is it true that the business condition is getting worse? If we look at these two numbers, then we cannot say that the business is getting worse because the decrement in liabilities is higher compared to the decrement in asset. Asset has decreased, but the decrement in liabilities are higher. The decrement in liabilities is 30%. The decrement in asset is only 7.4%. So now after we analyze using this horizontal analysis, then now we can say that the business is getting better or not getting worse, because the decrement in liabilities are higher compared to the decrement in the asset. If we do not do the analysis, we will say that the business is getting worse because the asset has decreased. That is what we do. If we do not do, that is what we say. If we do not do the analysis. But when we do the analysis, we compare. The total asset decrease 7.4%, but the total liabilities decrease is 30%. So now we will say that the conclusion after doing the analysis is the business is not getting worse because the decrement in asset is small compared to the decrement in liabilities. Okay, so that is about the finance income statement. So don't worry about this thing. Okay, the next thing that you have to know is about how to do the horizontal analysis for the income statement. Okay, remember, income statement shows the performance of a business. So let's see. To do the horizontal analysis, you need 2 years data. Current year data, in this example, 2000x2, and previous year data, 2000x1. So, see here. So, see here, for these 2 years data, if you do not do the analysis, what is your conclusion? In year 2000x2, the profit is 91%, 91,000. In year 2000x1, the profit is 76,500. So if you do not do the analysis, you just see the number, you will say that the company is getting better. Why getting better? Because the profit is higher in current year compared to the previous year. So let's see how now we do the analysis. Now we see for every item you have to do the same thing. You have to prepare column number 4 and 5. You have to calculate the decrement in terms of amount and the percentage. See here, the way is same. For item 1, current asset. Sorry, actually the item number 1 is sales revenue. So the increment in sales is 296,500 divided by the base year or current last year data, 1,234,000. 1,234,000. So the percentage increase is 24%. For every item, you have to do the same thing. For the second item, so you have to do the same thing. So you have to prepare the column number 4 and 5. Okay, now after you have prepared the column 4 and 5, now you learn how to interpret the data. So remember I said if we do not do the analysis, we will say that the company is getting better because the profit has increased. But now we do the analysis. So here, when you do the analysis, you have to check this one at least. Sales, okay, the increment in sales is 24%. But when you check the profit, the increment is only how much? 19%. Increment in sales or revenue is 24%. Increment in net income or profit is only 19%. So how? Now, after you see this number, these two number, can you say the performance of the business is getting better? We cannot say that now. If we do not do the analysis, we say the performance is getting better because 91,000 profit this year. Last year only 76,000 profit. But after we do the analysis, we check these two numbers. Sales increased by 24%, but profit only increased by 19%. So now we cannot say the performance is good because if the performance is good, the increment in sales of 24% will cause increment in profit also at least 24%. That is good. But now the thing is cannot be said as good because the increment in sales 24%. The increment in profit only 19%. That is not very good. Now you can check why this thing happened. This thing happened because the sales increased 24%. The cost of goods sold increased 27%. The cost increased higher compared to the increment in revenue. And then you can see selling expenses also increase more than the increment in sales. That is not good. That's why the increment, the profit increase is less compared to the increase in sales. So now, before analysis, we say the business is getting better. After we do the analysis, now we cannot say the business is getting better because the increment in profit is less compared to the increment in revenue. Okay, so that's the horizontal analysis. So focus on income statement and balance sheet only. So let's see here. The comparative cash and accounts receivable for a company are provided below. Cash in year 2000X2 is 62,500. 2000X1 50,000. Account receivable 74,400 and 80,000. Based on this information, what is the amount and percentage of increase and decrease that will be shown in a balance sheet with horizontal analysis? So remember, when you have to do the horizontal analysis, you have to calculate a decrease or increase in amount and also in percentage. So how to answer this? You have to calculate the amount and also the percentage. The amount is for cash, the amount is 12,500. Increase, the percentage is 25%. For account receivable, decrease 5,600. The percentage is 7%. Okay, so now that is the horizontal analysis. Now we see the method number 2, vertical analysis. Vertical. Imagine a vertical line. What is a vertical line? Okay, so a percentage analysis used to show the relationship of each component of the total within a single statement is called a vertical analysis. For horizontal analysis, you have to have 2 years data. But for a vertical analysis, you have to have only 1 year data. 1 year data is sufficient. Let's see. In a vertical analysis of the balance sheet, each asset item is stated as a percent of the total asset. Each liability and stockholders' equity item is stated as a percent of the total liabilities and stockholders' equity. Okay, see here. Okay, so how to do a vertical analysis? So to do a vertical analysis, you have to do the thing like this. In this sample question, there are 2 years data, year 2000X2 and year 2000X1, and then if a question asks you to do a vertical analysis, then the thing that you have to do is to prepare the column number 3 and column number 5. See the column number 3. Column number 3 is for year 2000X2. See item number 1, current asset is 48.3%. How to get the 48.3%? 48.3% is equal to 550,000 current asset for the year X2 divided by the total asset, 1,139,500. Then you will get the 48.3%. So remember, when you do vertical analysis, the total asset is always 100%. The total asset is always 100%. And the second thing is the total liability and stockholders' equity also always 100%. So then you just calculate the percentage. See here? For the current asset, how to calculate the percentage? 550,000 divided by the total asset, 1,139,500 equal to 48.3%. So you have to do the same thing for every item. Total asset is always 100,000 and total liabilities plus equity also always equal to 100,000. Okay, that is way. So first you have to know how to do the calculation, or how to prepare the column number 3 and 5. The second thing is you have to know how to interpret the data. See here, so you can see here the total asset. Okay, you can see here when you want to decide about the business, whether it is getting better or getting worse. So you can check there. When you see a balance sheet, focus on the comparison or the total percentage of total liabilities. In accounting, we say a business is in a good financial condition if the total liabilities is small compared to the total asset. See here, if you see here, the total liabilities is only 27.2% compared to the total asset. So the condition of the business is good, because 27.2% is like this. If the business has $100,000 asset, the business only have 27,000 debt only. So that is good. If the debt is less than 50% of the asset, it is good. It's still good. So if we compare the debt or liabilities for 2 years, in the previous year, the total liabilities is 36%. And then in the current year or year 2002, the debt is only 27.2%. So the business is getting better. The financial condition of the business is getting better. If you check that the liability percentage is getting higher, then the condition of the business is getting worse. Okay, so this is the way to do it. And then how to do vertical analysis for income statement. So remember, vertical line is like this. So that is the way to do the analysis. So if you have to do a vertical analysis for an income statement, then you have to do the things like you see in this slide. You have to calculate the column number 3 and number 5. You have to calculate the total. So for this, always remember, the net for income statement, when you calculate or do a vertical analysis for an income statement, then you always have to remember the net sales is the 100%. The net sales is 100%. So for example here, if you see here, if you do not do the analysis, you will say that the business is getting better. If you do not do the analysis, you will say the business is getting better, because in terms of performance, because you see in year 2000x2, the profit is 91,000. In year 2002 the profit is 76,500. So if we only see these two numbers, we will say that the business is getting better because the profit is getting higher. But remember, the point is, if we want to make a good decision, we have to analyze first. So we do this analysis. We do the the vertical analysis. So you calculate the percentage. So this is the way to calculate the percentage. The net sales is always 100%. Okay. After you do the analysis, then you have to know how to interpret. Remember how to. So this is the way to interpret. So you see the net income. The net sales is always 100%. You see the net income. In year 2000X2, the net income is 6.1%. But in year 2000X1, the net income is 6.4%. So now, after you do this analysis, can you say the business is getting better in terms of performance? No, we cannot say that the business is getting better in terms of performance. Maybe the business is getting worse. Why we say that? Because when we do the analysis, we found that the percentage of profit in year 2000X1 is higher compared to the percentage of profit or net income in year 2000X2. That is the correct conclusion to make. You do a good conclusion after you analyze. If you do not analyze, if you do not do the analysis, then you will say that year 2000X2 better than year 2000X1. Thank you very much. In this lecture, you have learned two methods: horizontal method and vertical method. Okay, remember how to do this, how to do the analysis, and also you have to know how to interpret the number. In the next lecture, I will explain about method number 3, financial statement ratio analysis. Do not forget to write your name and metric number in the comment section because I will take it as your attendance.